Good evening, everybody. Welcome back to Strongman Personal Finance. My name is Christopher Allen Bell, certified public accountant. I have a stock portfolio of approximately $630,000. And I have, as of today, decided to retire early and invest that entire 630,000 portfolio into one ETF, one investment that will pay me passive income in the range of approximately $550,000 a year, allowing me to retire at the age of 35. I am excited to share with you, my loyal fans, and anybody new to this channel, the ULTY Ultra Income ETF, which will allow you to retire, to quit the rat race forever with a lot less money than you might think. So let's dive right into this company, and I'm going to give you my justification and assuage some concerns about this ETF. So there's this very awesome company called YieldMax. And what YieldMax does is they find very high performing stocks or, very popular stocks. And what they do is they use call options, put options, and sometimes they buy the underlying shares to make synthetic versions of those stocks. Basically, they're using options to recreate the price fluctuations of the underlying stocks. And then on top of that, they write or sell call options to generate income. And with their options trading prowess, they are able to generate insane returns that have never been seen before in the finance industry. It's absolutely wild what they're doing. And these returns are distributed back to you, the investor. And a lot of people, they always wonder, how can I retire? Some people, they work for the government and they put money every paycheck into their pension, and they have to wait until they're 50, 55, 60 years old to access their pension. For Social Security, you have to wait usually until you're 62 to draw out of it. People put money into their 401ks or their IRAs, and generally at 59 and a half is the first time that you can access that. And people don't believe that they can retire a lot younger. And that's unfortunate, because with this new ETF, with this new company that is doing amazing things, you can actually retire. I would argue if you have $100,000, you could probably retire now. And I, after working my butt off for the past 14 years, I was in the Army. I've worked in public accounting. I'm a self-employed tax person. I have a full-time job. I have 2 children. It's time to step away from the rat race. It's time to focus on what matters most in life, which are my children. And I want to spend more time with them instead of spending all day at work, grinding away for a corporation, boosting the corporation's profits for minimal compensation. I believe that's a horrible thing that most people think they're trapped in. And I'm here to tell you that you're not. And I found the ticket to early retirement, and I want to share that with you. So let's reveal the YieldMax Ultra Option Income Strategy ETF, ticker symbol ULTY. This has been all the rave on YouTube. And I honestly have not heard, I didn't hear this ETF until recently. But once I saw what it was doing, I was absolutely blown away. So first, let's dive into what everybody's concerned about, NAV erosion. So if we look at the 5-year chart, we can see that the ULTY ETF is down 71.11%. And a lot of people will look at you and they'll say, Strongman, Christopher, you are an absolute fool, a clown, and a moron for putting $630,000 into an ETF that has dropped down 71% in the past 5 years. Well, first of all, this is basic finance. Past performance is not indicative of future results. Just because something went down 71% in the past doesn't mean that it can continue to go down at that precipitous rate into the future. They can also do a reverse stock split, which means the value of the shares will go up precipitously as soon as they execute that. That's an option that YieldMax can do. On top of that, you need to understand the concept of total return. Total return is all that matters. The total return is the stock price fluctuation plus the dividends. Let me repeat that. The total return of any investment, which is all that matters, is the stock price's movements plus the dividends distributed. And the reason that you have to add dividends is because the stock price of any investment drops by the amount of dividend distributed. So when you look at a chart like we're looking at here, and we see ULTY's down 71%, you would be 100,000% misguided if you believed that by buying this ETF over the past 5 years, you would be down 71%. That is 100% fallacious. You would actually be up, in my humble opinion, because if you include the dividends that were distributed to the shareholders and you add that to the price fluctuation, you'd be surprised to see that your returns are a lot more positive. So the concept of NAV erosion is utterly ridiculous because the only thing that matters is total return, and you cannot see that on a stock price. In order to calculate the total return, you'd have to subtract the drop in the stock price, and then you'd have to add all the dividends that you received. You cannot see that on the chart. Do you understand me? So that being settled, which I hope it's settled for all you haters out there of YieldMax, and I guess you hate work. I guess you hate early retirement and freedom. This fund currently has $3 billion of assets, $3 billion of assets with an expense ratio of 1.3%. Now that's a very high expense ratio. I'm not gonna lie. That is a very high expense ratio. But if you consider that, and we're going to look at the yield of this in a second. If you consider the returns that you're getting, the total returns that you're getting, that's a joke of an expense ratio. It doesn't matter. So if I were a fund manager and I came to you and I said, hey, Bobby or Jessica, I'm going to give you 20% return every single year, and I'm going to charge you 2%. Your return after the fee would roughly be 18%, correct? But what if I came to you and I said, hey, I'm going to give you a 5% return, but I'm going to give it to you for free. I'm not going to charge you anything. Which one would you rather take? Well, in my humble opinion, I'd rather get the return after fees of 18% versus the return after fees of 5%. So ultimately, the expense ratio is compensation for the fund managers who are able to generate such massive returns that they, in my opinion, should be compensated for. That's my thoughts on the expense ratio. Okay. So it's got a PE of 42. And when you consider the underlying holdings of this ETF, which we're going to go, I downloaded a CSV and we're going to look at that. The PE ratio is a function of past earnings. So a lot of the companies that they hold are very high flying growth stocks, and growth stocks have high PEs because a price to earnings ratio is looking at the past earnings. But if your earnings are growing precipitously into the future, the PE ratio from the past is almost irrelevant. Really what matters is the forward PE and how much earnings and profit you're going to receive from your investment into the future. So I would not panic about a PE ratio of 42 and 42.66. So the best thing, number one, trailing 12 months of dividends is $7. So let's look at the last 12 months if we can do that. 1 year. So the price of this ETF has dropped from $11.06 to $9.50. So if we take 11.6 and we subtract 5.90, it's dropped $5.16 in the last 12 months. Are you understanding me so far? So that's a loss. It's dropped 5.16. But we have a dividend yield of 7.14. So the difference between those two is actually the total net return. So if it only dropped by 5.16, but you got a dividend of 7.14, guess what? You got positive roughly $2 of total return from this ETF. Do you see why total return is very important? Next, we look at the dividend yield, 121%. So I have a $630,000 portfolio. I know. I'm a broke idiot. And you multiply that by 1.2109. I can generate off of my portfolio with that dividend yield $762,000 a year. Do you think I could possibly retire off of that? I would think so. And on top of that, I don't have to take all the dividends. I could actually reinvest the dividends and buy more shares. So if I only have a budget of $100,000, I can reinvest $662,000 back into this ETF every year and buy more shares. And my income will grow and grow and grow and grow. Now, they pay out weekly, which is awesome. Absolutely awesome. So by paying out weekly, you don't even really have to budget. You know every week you're going to get a dividend distribution, and you can get that directly into your bank account. Isn't that awesome? So you can reinvest however much you want, and if you need some expenses, that dividend comes in. You don't have to sell shares. You don't have to do anything. You just take the dividend. I can't think of a better product than this ETF. Now, you always got to wonder, what are you investing in? So I went on the YieldMax website. I pulled up ULTY. So here it says the distribution rate is 88.07%. They have a specific formula they use to calculate that. I think they take the last month and they multiply it by 12, and that's kind of how they get it. So you see a little bit of a variance between the dividend yield on stockanalysis.com and the YieldMax website. I wouldn't be too concerned about that. You're probably going to get more than that, in my humble opinion. The 30-day SEC yield, that's a weird formula by the Securities and Exchange Commission, which, oh, by the way, the SEC was anti-cryptocurrency. So I don't know how much faith I would put into the SEC and their weird formulas for calculations, okay? So if we go down, we can see the performance. So 1 year, cumulative returns, 13%. But I thought that this ETF just went down. I thought it just went down. 3-month return, 29%. But strongman, it's going down. It's going down. Look at the past year to date. Look at the year to date. Or let's do like 1 month. Okay. So it's down what? 50 cents. It's down 50 cents in a month. Well, what if you got $1 in dividends? What was the most recent dividend distribution? Okay. What is it? 10 cents? So that's a little concerning. So it looks like they had some issues in the last couple of months, but that's temporary market fluctuations. Okay. But if you think about it, if you look at the actual returns, 29% in 3 months. What's the issue? You see the price going down, but you're not understanding that you're also getting the dividend, which causes the price to go down. That's why the price is going down, because you're getting the dividend. Do you understand? Got it. Okay. Now let's look at some of the holdings, because these holdings are very interesting. So we go down the list here. So I downloaded the CSV, and it's got a bunch of data on here, but I did a little pivot table to make it easier to see and digest, and we can go look at some of the holdings. So they got call and put options on a firm, and then they have $100 million in a firm. A firm is a buy now, pay later company. That is all the rave. Everybody's using buy now, pay later. Okay. It's a way for people to pay for their burritos, the meme, over 4 payments, something like that. So a firm I'm very bullish on the company. Okay. We got Applied Materials. That's another high flying stock, 80 million in there. We got AppLovin, a wonderful, wonderful tech company. How well has this stock performed recently? Let's go look at this. So we got AppLovin, McLovin. I'm McLovin, AppLovin. So over the past 5 years, AppLovin's up 448%. Man, what a horrible investment for YieldMax to put their money into. Let's look at Applied Materials. Let's see how well Applied Materials has done. AMAT. Over the past 5 years, it is up 139%. Wow. Well, such a terrible pick. Okay, we got AST Space Mobile. We got BitMine. So BitMine, I believe, is a Ethereum-based fund. It's kind of like an Ethereum treasury fund that is managed by the world-famous Tom Lee. He's featured on every YouTube channel, and he's commonly featured on CNBC. He's a very, very experienced fund manager that has called a lot of things accuracy, and I place complete faith, utter complete faith, into the predictions of Tom Lee. And I apologize. Somebody's texting me here. Okay. So they roughly have, let's see, 20 or $200 million in cash. That's for distribution. That's how you get your distributions. It has to come to cash first. They got Coinbase, 144 million. Let's see how Coinbase has done. Okay. Oh, this must be another horrible pick by YieldMax. So in the past year, Coinbase is up 62%. Man, wow. Oh my God, it's so bad. Next, they have Galaxy Digital. Let's see what that is. Galaxy Digital. I'm sure it's up massively, but even if it's not, nobody's perfect. But overall, I think they've picked some winners. Okay, in the past year, it looks like it just started trading, but it's up 11%. Okay. I mean, we go down this list. Oh, they got Robinhood options. They have Ionic, Quantum. Have you heard of quantum computing? Yeah. I'm actually liking Mara. That's cryptocurrency. That's Bitcoin mining. MicroStrategy. You ever heard of that? How much has MicroStrategy been up? Let's see. So if you understand the underlying holdings, you've seen that they've been picking absolute winners. Absolute winners. MicroStrategy in the past 5 years is up 2,398%. I wonder if the dividend's sustainable. Wow. All right, we got Nebius Oklo, another winner. So I think Oklo has been doing pretty well. Let me double check Oklo. I know they did earnings recently. I'm pretty bullish on Oklo. So in the past year, it's up 833%. Winner after winner after winner after winner after winner. Win, win, win. Let's keep going down the list. Palantir, that's up like 10,000%. Palo Alto, Reddit, that's flying. Rigetti, another quantum computing. Rocket Labs, it's a rocket lab. It's a rocket, haha. Strategy, Target, Tesla, another company that's probably going to be a $20 trillion market cap. And the world famous Webull, which just IPO'd. So I'm looking at these companies, Webull, Upstart, Unity, Tesla. I'm seeing amazing picks. And these are the companies that are going to help generate passive income for you. So all you haters out there laughing, they don't even understand what's in the ETF. I just showed you what's in it, and it seems like they're doing pretty good when you factor in total return. Huh? So what do you guys think about ULTY? Yes, there's NAV erosion. Yes, I understand that. But if you're actually a sophisticated investor, you understand the concept of total return, and you understand the concept that, if you buy and hold and reinvest dividends, you'll have more shares. I don't think I need $760,000 of income every month. So I'm extremely happy that I've put my entire portfolio in this, and we'll do some comments. All right. So before we get into the comments, book a free consultation with me. I'm a certified public accountant. I do business or personal taxes any state in the United States. You can talk to me for free. I give you upfront quotes, and I can prepare your taxes like a boss. Free consultation, 30 minutes. Dobie, we got Dobie. Say no more. I'm going all in. Alan Carlson, yesterday you were criticizing Elon Musk for constantly lying. The majority of your content today is literally nothing but lies. The hypocrisy is, what are you talking about? Why are you always complaining, Alan? I don't understand. Did Jay Nagy tell you might be back? We need that true American. Oh, yeah, I think he'll come back in a little bit. He just needed a little bit of a break, but he's alive. You could say you're just joking or being sarcastic, but Elon can make excuses too. Well, number one, Elon is the CEO of a publicly traded company and the richest man in the world. I'm a little YouTuber. YieldMax guy looks like a dang fifth grader clown. That's funny, Gil. Party man, this is a joke video. Okay, well, you believe whatever you want. Anyway, thank you for tuning in. Book a free tax consultation with me. Like, subscribe, hit the bell button for notifications, and you guys have a wonderful, delicious weekend. Cheers.